Good evening, guys. Please confirm if the audio and video is clear to everyone. Please confirm if the audio and video is clear to everyone. Yeah, wonderful, thank you. So, as I told yesterday and announced it, that I'll be conducting mock tests. So, I believe all of you would have appeared for the mock tests. I believe all of you would have appeared for the mock test, and now today I will be discussing the questions. Okay, so now in the mock test, there is ACCA FR pre mock exam for the September 2023 attempt. Okay, now see, there are 32 questions if you can recall. So section A is from question number 1 to 15. Section B is from question number 16 to 30. So these questions you can get the evaluation of it, right? These questions you can get the evaluation of it in the ACCA practice platform itself. Now coming to section C, question number 31 and question number 32. The examining team gives you the solution for this, but they don't provide the evaluation of it. They don't provide the evaluation of it. Now today in this class, I will be discussing section C for. I'll be discussing section C. Okay. If you have any queries in section A and section B, you can discuss with me personally over the WhatsApp. I will not be discussing it off here. I will be discussing only section C here. Okay. This video is only for the section C. Okay. Is that clear, everyone? Is that clear, everyone? Shall I start the discussion? Shall I start the discussion? Yes, Swam, I will be discussing that in the ACCA practice platform itself. Okay, I will be solving that in the ACCA practice platform itself. Is that clear, everyone? Shall I proceed further? But before I proceed, please guys, like the video, like the session. Okay, if you guys are watching the session, please like it off. We'll proceed further. Okay, so now just let me make the arrangement. Let me make the arrangements. I will go according to the seriatim, Riddhi. Now, can you see the ACCA global platform? Can you see the ACCA global platform? Now, what we'll do is we'll go to the student section, ACCA study support resources. Now, we'll go to the ACCA qualification. We'll go to the financial reporting paper. Now, in the financial reporting paper, we will go to the past papers and questions practice. Now, here we log into the ACCA practice platform. Credentials are already there, so you can enter your credentials and log in. Now in the credentials, if you enter the credentials, what you can do further is go to the financial reporting paper. Now click on the plus. Now after clicking on the plus, you can there are two things: ACCA official resources and the blank workspace. Blank workspace is for the practice of the questions which is not there in the ACCA practice platform, but we have to practice pre mock exam which is there in the ACCA practice platform. So we'll go to the ACCA official resources. Now are we solving the past exam library? No. How many questions are there in the past exam? See, 1 2 3 4 5 6. I believe all of you had already solved these questions. I believe all of you would have already solved these questions. Okay, now coming to practice exams. So I believe practice exam 1 and practice exam 2 you would have already solved, right? And this is what we are going to solve now. FR pre September 2023 mock exam. FR pre September 2023 mock exam, right? See, it is already assigned to me. Right? Now those of you who have not solved it, you have to assign it to yourself. Okay, now once you assign, it will appear here like this: pre September 2023 mock exams. Right now, so it is for FR paper. So I was already checking the paper today morning, right? I was going through the paper today morning. So this is the paper. Now let's resume the discussion of it. So it says section A is of 15 objective type questions. Each question is of 2 marks and the total is of 30 marks. Okay. So I will not be discussing A and B now. Directly jump to question number section C. I'll directly jump to section C. Section C, question number 31. So this is the question of section C. Tell me, can you see the question? Is the question clearly visible to all of you? Is the question clearly visible to all of you? Is the question clearly visible to all of you? Wonderful. So let us discuss these questions. So what is this question pertaining to? So let's read the question first and understand. Okay, this is how you are going to solve in the exam also. Okay, this is how you have to solve in the exam. The way I will be solving now is the way you have to solve in the exam. Is that clear? Okay, fine. So let's read the question. Dorrit company acquired 75% of the equity share capital, 75% of the equity share capital of Twist company on 1st July 2008. Okay, the acquisition took place by means of share exchange of 2 shares in Dorrit for every 3 shares acquired in Twist company. 2 shares in Dorrit for every 3 shares acquired in Dorrit company. Okay. Now, why I am highlighting these things? Why I am highlighting these things? See, so that I don't need to read the question again and again, and I will save my time here. Okay, guys, when I'm discussing this question, it is not the case that I'm discussing only the concepts here. I will be discussing the approach in which you have to read the questions in the exam. Okay, approach in which you have to solve the question in the exam. Okay, so now, so keep on highlighting the important points, the data which you will require further. Keep on highlighting the data which you will require further. At the date of acquisition, shares in Dorrit company and Twist company had a market value. Dorrit and Twist will have a market value of this and this. Okay, fine. So let's highlight. Now further, the remainder of the consideration was cash payable on 1st July 2009, meaning thereby after what period? See, the date of acquisition was 1st July 2008. Payable on 1st July 2009 means 1 year difference. 1 year difference. Okay. Now we have to understand that it is a deferred consideration or contingent consideration. So let's read the further. Let's further. Dorrit company will pay how much? Pay 28 cents for each acquired share. Pay 28 cents for each acquired share means fixed amount of money after a fixed period of time, and the payment is also fixed, means it is a deferred consideration which we will recognize at the present value on the date of acquisition. So what is the cost of capital? It is 8% per annum. Okay, none of the consideration has been recorded in the books of Dorrit company. Okay, it is not recorded. Fine, we will record it off. No worries, no worries. Okay, further, it gives you the statement of profit and loss for Dorrit company and Twist company. Dorrit company being the parent company, Twist company being the subsidiary company. So it gives you the profit and loss. It gives you the SOFP. Okay, now, but understand one thing here. What was the date of acquisition? 1st July 2008. What is the reporting date? 31st December 2008. These are important, guys. These are very important. Noting the date of acquisition and the reporting date is quite very important. Okay, you have to identify this in the question. Now going further, what are the adjustments? So the question is giving you SOFP and P&L both. Okay, so now going down, it says immediately after the acquisition of Twist company on 1st July 2008. Okay, immediately after the date of acquisition means what? My date of acquisition was 1st July 2008. My date of acquisition was 1st July 2008. So immediately after the date of acquisition means on 1st July 2008 itself, on the very same day, Dorrit company transferred an item of plant with a carrying amount of 3 million. Carrying amount was 3 million, but it was transferred for an agreed price of 5 million. It was transferred for an agreed price of 5 million. Okay, now at this date, the plant has a remaining useful life of 2.5 years. Dorrit company had included this profit on transfer as a reduction in the depreciation costs. All depreciation is charged to cost of sales. Now this I am changing the color. Why? Because this is a treatment. This is the treatment that I have to do. Okay. Now further. at the date of acquisition, on the date of acquisition, it is saying the fair, the guys tell me, is the question clear to everyone till here? Is the question clear to everyone till here? Now, at the date of acquisition, the fair value of the twist company, that is subsidiary companies, assets and liabilities, were equals to the carrying amount. I believe you are aware that on the date of acquisition, the parent company records the assets and liabilities of the subsidiary company at its fair value on the date of acquisition, right? Now, that's the reason why it is saying that the fair value of the twist company assets and liabilities were equal to the carrying amount, with the exception of twist company property, which had a fair value of 14 million above its carrying amount. Means we have to do the fair value adjustment on the date of acquisition. We have to do the fair value adjustment. So right, let's understand fair value above its carrying amount by 14 million. Okay, now for consolidation purpose, this lead to an increase in the depreciation charges, okay, of 3.35 million. Oh, it is giving you the consequential impact of that also. The question is giving you the consequential impact. Question is giving you the consequential impact of that. Okay, either generally we calculate it off. Generally we calculate it off. But here in this case, the question is giving you the data. Okay, now. Guys, are you understanding the importance of highlighting these points? When you highlight these points, what happens while reading the question, while you are highlighting these points, you are making your task easier. You are making your task easier while you are solving the question. The task will become quite very easy for you. Okay, and there will be very less chances of missing any information or skipping any information or any data given in the question. Is it clear, everyone? Is it clear, everyone? Now, the policy of Dorit company is to revalue all the properties at to fair value at each year end. Okay, let's go and see in the P&L. See in the P&L. In the P&L of Dorit company, we are recording the revaluation gain. In the P&L of Dorit company, we are recording revaluation gain, but in the twist company, we are not recording revaluation gain. In the case of twist company, we are not recording revaluation gain. So it appears to me, prima facie, it appears to me that Dorit company is using the revaluation model for its properties, but twist company is using the cost model. Okay, now, but if you can recall our regular classes, we discussed this whenever the parent company consolidates the subsidiary company, first of all, the accounting policies should be made uniform. Okay, so now if the parent company is using the revaluation model for its properties, now we have to apply the same model to the non-properties of the twist company as well. Now, what is saying here? See, the policy of Dorit company is to revalue all the properties to fair value at each year end. On 31st December 2008, the increase in Dorit company property has already been recorded. However, a further increase of 2.1 million in the value of twist company's property from acquisition date to 31st December 2008 has not been recorded. Right? So what we have to do? We have to record these. So we are making the accounting policies uniform. We are making uniform accounting policies. Now further, in the period since the acquisition, there was an adverse publicity concerning one of the twist company's major product lines. As a result of the goodwill which arose on the acquisition of the twist, so it says that the goodwill has been impaired. Goodwill has been impaired by this amount at 31st December 2008. Okay, at 31st December 2008. Now, further, the impairment should be treated as admin expense. So, which color shall I take? I will take this color. Right, treatment. See, the treatment, I am taking this color. Treatment, I am taking this color. Treatment, I am taking this color. Are you understanding this part? Treatment, I am taking this color. Are you understanding this part? Now, some of you might say that, sir, it will waste lot of time. It will not waste lot of time. It will save lot of time. Okay, please understand, my friends, that it will save a lot of your time. Okay, it will save lot of your time. right? Now, Dorrit company's policy is to measure the non-controlling interest at fair value on the date of acquisition. For the purpose of measuring the non-controlling interest, assume that the Twist company share price is the date at that date is a representative. Oh, it says that NCI is measured at fair value, but it is not giving you the fair value. Why? Because the question says that use the market price per share of a Twist company to calculate the fair value of NCI. So it will be of no use to me further. It will be of no use to me further. So let's strike it off. We don't need anything. We don't need this. Okay, we know this. Okay, assume except as indicated otherwise all the items of income and expenditure accrue evenly throughout the year. We don't need this also. Let's remove this off. Tell me now. So is the question clear now? Is the question clear now? Tell me. Is the question clear now? Tell me. Anyone having any queries in the question? Anyone having any queries in the question? Tell me. Now, so let's come to the requirement part. Let's come to the requirement part now. What is the requirement part saying? Calculate the goodwill arising on acquisition of Twist company on 1 July 20x8. What is the meaning of 1st July 20x8? Means the date of acquisition. What is the goodwill on date of acquisition? So let's start to solve this question. Working note, not working note. What is the requirement? Requirement A, right here. Requirement A, goodwill. Just a minute, guys. Requirement A, goodwill on 1 July 20x8. Okay, so let's increase the width of this one and bold this one, the requirement. But to calculate the goodwill, we need three things: investment, we need NCI, we need fair value of the net assets on the date of acquisition. So let's write here investment. What is the value of investments? Then we write here what is the fair value of NCI on date of acquisition. Then write here less what is the fair value of net assets on date of acquisition, right? And with this you will calculate what? So you will have to do this plus this minus the net assets. So this will give you the value of goodwill, but we need to find out these values. right? We need to find out these values, right? So let us start one by one. Let us start with investment. So right here, working note number 1. Investment is working note number 1. So let's focus on working note number 1, investments. Okay, now investments. Now, what is the value of investments? Okay, so come here, top. So it says that I am acquiring 75% of the equity share capital. So can you tell me what is the total equity share capital of Twist company? Equity share capital of Twist company? It is 31,500. Okay, and it is $1. So number of shares are 31,500. Okay, so you can write here fair value of share exchange. Okay, now how will you calculate the fair value of share exchange? So you will write here in the bracket. So guys, do not forget to show these notes. If you show these notes, definitely you will not get any extra marks. But if you don't show these notes, what will happen? I will tell you what will happen. Okay, but first of all, let me calculate this. 75%, 31,500 multiplied by 0.75 multiplied by how many shares? 2 for E, 2 for every 3. Now these 2 shares are issued for the Dorrit company. So what is the market price of the shares of Dorrit company? 3.2. Okay, so this is the share exchange. This is the value of share exchange. So what will you do here now? Just copy it off. Copy equals to paste. Done. Will you get any extra marks for this in the exam? No, you will not get any extra marks. But why are we showing? I will tell you why. Okay, now further, what is the present value of deferred consideration? What is the present value of deferred consideration? Okay, now what is the amount of consideration that I'm paying deferred consideration? So it is per share I am paying 28 cents. I am paying 28 cents. So 31,500 is the total share capital of Twist company, but in that I have acquired only 75%. So this is the number of shares that I have acquired. For each share acquired, I am paying 28 cents. So multiplied by 0.28. Okay, so this is what I will give. Okay, this is what I will give after 1 year, but since it will be paid after 1 year, I have to do the present value now. So divided by 1.08. Copy. Done. 6125. So this is the value of your investment. This is the value of your investment. All so is equals to sum equals to sum. Now understand, guys, I'm teaching you something. Understand, please. Let's suppose if you have shown these calculations, okay, okay. Now further, working note number 1 is equals to, I'm writing it here, 56525. Now understand, let's suppose since you have given the reference of working note number 1 here and linked the figures, okay, given the working reference, then what happens, and you have shown all the working notes, so what happens, let's suppose you have calculated this figure wrong. Let's suppose you have calculated this figure wrong. Okay, this figure, fair value of share exchange, you have calculated wrong. So definitely you will not get marks for that. But if you link this figure, if you give the reference, if you show the working notes, then subsequently, let's suppose, see, if this 50,400 is wrong, then this amount that will come here will also be wrong. Then amount which will come here will also be wrong. Then the goodwill will also be wrong, right? So what I'm trying to say, if this is wrong, definitely you will not get marks for this. But what will happen subsequently, if you give the working notes everywhere, you will get the marks for that using the concept called as own figure rule. Okay, so you have to give the working notes as much as possible. Yes, he's saying this is something which irritates sometimes, like every time we need to go to each cell for typing, for editing. Yes, yes, Gupta, that's we are helpless. Okay, we have to deal with that. There's nothing we can do for that. Now, fair value of NCI. So how will we calculate fair value of NCI? Tell me, how will we calculate fair value of NCI? Now we will calculate fair value of NCI is equals to, okay, now total shares is not equals to, you can do here 31,500 was the total share capital of Twist company. NCI will have how much? 25%. NCI will have how much? 25%. Now what is the market price per share of Twist company? That is 2.3. That is 2.3. So it is equals to, what is the short form that I have used? Tell me. What are the short forms that I have used? Tell me. What are the short forms do you think I have used? Swayam. Now fair value of net assets. So this is working note number 2. Okay. Now let's come to calculation of this one. Working note number 2 is a statement of net assets. Okay, now NA, yes, you can do that. You can use the short forms. That till to that extent you can use it. Okay, but yes, I will recommend at least at one place you just define the short forms. If you can do that, it's good. If you cannot, that is also fine. No challenge in that. Okay. Now tell me, what is the date of acquisition? That is 1/07/20x8. Okay, 1 July 20x8, or you can write 1 July x8. Okay, now what is the reporting date? That is 31 December x8. This is the reporting date. Okay, now further let's proceed. Now tell me what we will write. Share capital Then retained earnings. Retained earnings. Right now, tell me what is the share capital of Twist company on the reporting date? What is the share capital of Twist company on the reporting date? 31,500. What is the share capital of what is the retained earnings of this one Twist company on reporting date? 12,250. Right? See, this I have just pasted from the answer. On the reporting date, 31,500 and 12,250 is what I have just pasted from the answer. Nothing else I have done. I have not done anything extra. I have just pasted from the question. Is that clear, everyone? Is that clear, everyone? Now, tell me, we read the entire question. Tell me, Twist company is issuing any new shares? Do you think Twist company is issuing any new shares? Twist company is issuing any new shares? No, Twist company is not issuing any new shares, right? So what will happen? The share capital on the date of acquisition and the reporting date will be the same. Will be the same, right? Now coming further to the retained earnings part. Now see, the closing retained earnings is given in the question as 12,250. Now we know what is the profit earned by Twist company, that is 7,000. But this 7,000 is for the entire year, but the subsidiary was acquired in the mid of the year. The subsidiary company was acquired in the mid of the year, right? So now what I will do, I will say the post acquisition profit is 7,000 divided by 2 is 3,500. 7,000 divided by 2 is equals to 7,000 divided by 2 is 3,500. Now what will be the opening retained earnings? The opening retained earnings, this minus this is your opening retained earnings, that is 8,750. Tell me guys, is that clear, everyone? Is that clear, everyone? Is that clear, everyone? Okay, now how did we arrive this 3,500? We arrived 7,000 divided by 2. 7,000 divided by 2 because 7,000 is the profit for the entire year. 7,000 is the profit for the entire year. 7,000 is the profit for the entire year. So we divide by 2 and arrived at this. Okay, now further. Though this post acquisition profits can be derived in multiple ways, which we have discussed in our classes, okay, which we have discussed in our regular classes, and also I have discussed that in my revision video for the group accounting. Now further, so this gives me the carrying amount of the net assets. Now further, if you come to the adjustments now, what was the adjustment? See, now tell me this one, immediately after the acquisition, Twist company, just keep it hold. Just hold this part. I'm not discussing this part as of now. Now coming to the second part, at the date of acquisition, the fair value of this one, right? So what was the fair value adjustment? Fair value excess fair value. So I have to do fair value adjustment. By how much? 14,000. And on what date? On date of acquisition, right? Now what is the subsequential impact? That is negative 350 is the excess depreciation on account of increase in the value of the assets, right? Tell me yes or no. So the impact of this is done. We are not required to deal anything further about this. Coming to the second point, it says for the Twist company. Okay, before I go to the next paragraph, tell me, is it clear to everyone till here? Am I going too fast? Is it clear to everyone till here? Is it clear to everyone till here? If I'm going too fast, please do let me know, guys. I'm waiting here for you guys, my dear friends. Wonderful. Now, so fair value adjustment is done. Now, further what it says, the policy of the Dorrit company is to revalue all the properties. The policy of the Dorrit company is to revalue all the properties to fair value at each year. Okay, it was the policy of the Dorrit company. That is the parent company. And since we are acquiring this company, we have to make the policies uniform, right? So what is happening is that on 31st December 2008, the increase in the Dorrit company property has been recorded. It is already recorded. But however, the increase in the 2.1 million value of the Twist company property from the acquisition till date has not been recorded. So we have to record this. So it will increase the post acquisition profits of the Twist company. So we can record it here. So we can say a revaluation gain on property we can say revaluation gain on property. How much? How much is equals to 2100. Now tell me, will it have any subsequent depreciation impact? Tell me, will it have subsequent depreciation impact? Any excess depreciation on this revaluation? Any excess depreciation on this revaluation? No, no, no. Why? What's the mistake that the student does? They think that this 2.1 million is the increase in the fair value of the assets on the date of acquisition, and they write 2.1 million here, and they write 2.1 million here, and they say that, sir, this 2.1 million is the increase in the fair value of the assets, so which we have to, since it was not recorded, means the excess depreciation on the same is also not recorded, so we will record the excess depreciation here. No, my dear friend, no, no. Okay, there are few other set of students who say that they correctly record the revaluation gain here 2100, but they say that I have to record here additionally, I have to record the excess depreciation also. No, my dear friend. Why? Because I am doing this revaluation on 31st December 20x8. Okay, since it is a post part, that's why I'm writing here. Otherwise no. Okay, it is happening on the after acquisition, on the reporting date we are doing. It is happening at the year end. So definitely it will have an impact of increase of depreciation, but that impact will be in the next year, not in this year. The impact of excess depreciation on this revaluation gain will be there, but from the next year, not from this year. So this is also done. Then this part, in the period since acquisition, okay, this is the goodwill impairment. Goodwill impairment will not come here, and everything is done. Done. Just leave one line item here. We have to discuss one point here. I'm moving forward now. I'm moving further. Okay, so it will give you the fair value of net assets. Okay, we have to discuss one point here, but just for the time being, hold it off. Is it clear everyone till here? Is it clear everyone till here, guys? Come on, tell me. Is it clear everyone till here? This is the allocation of the profits. I have not discussed this point with you guys. The transfer of PP, I have not discussed this point. I will discuss, but I will have to show the double entry movements. Okay, so if I discuss it now, it might create a confusion, so I will discuss it at the end. Okay, so first of all, I will do all the calculations, then I will show the impact of this one, then I will show the impact of this one. At the very end, I will show the impact of this one. At the very end, once I have done everything, it is then I will show the impact of this one. Okay, not before that. Okay, now, so let us write here. Now, what is the value of the net assets on the date of acquisition is equals to minus. This is the value of the net assets, right? Just a minute. Now tell me, is it clear everyone? Goodwill on date of acquisition, that is 1 July x8 is clear. Is it clear everyone? If revaluation is in mid-year, then we'll take excess depreciation. Yes, Gupta. Yes, we'll take. If the revaluation happens in the mid of the year, see now, this is this one. See no, this one. This revaluation, this fair value adjustment is happening on date of acquisition, that is in the mid of the year, and hence it has excess depreciation impact. Right? Why we take revaluation gain in statement of net assets? Now tell me, okay, now Riddhi, tell me, revaluation gain is the profit, is the gain or loss for which company? Parent company or subsidiary company? Revaluation gain is a gain or loss for which company? Parent company or subsidiary company? It's a gain for the subsidiary company. And this statement of net assets is for which company? Subsidiary company, right? This is for subsidiary company. Right? Hence we have to take it off. Pinky, definitely you can do that. That is not a point that we should discuss. Okay, so we can type in full capital letters, full small letters. It's totally fine. The examiner is not interested in your capital letters, small letters, abbreviation, full form, spelling mistake. If the examiner is saying till the time something is acceptable, we are fine with that. Okay, now even if there are spelling mistakes, it's totally fine. But if you are having spelling mistakes everywhere throughout, that the examiner is not able to understand your answer, that's not acceptable. That's not acceptable. That's not acceptable. Okay. Yes, Gupta is saying that why 2100 in post period. Now read no question. A further increase of 2.1 million in the value of Twist company from the date of acquisition to 31st December. So it is post period or pre period. Anything that happens till date of acquisition is on date of acquisition. Anything that happens after date of acquisition is post period. Tell me yes. Is it clear? Is it clear? Now, okay, so this comes, so first point we have solved. So 4 marks done. 4 marks done. Tell me, is it clear? 4 marks clear, everyone? Is the 4 marks sorted for everyone? Is the 4 marks sorted for everyone? Is the 4 marks sorted for everyone? Now, coming to the point number B. Calculate the following amounts for presentation in the consolidated statement of financial position, group retained earnings and NCI. See, now understand, guys. The question clearly mentioned here. That we need the value of goodwill on 1st July 20x8. We need the value of goodwill on 1st July 20x8. The question clearly mentioned here. But in this case, the question is not mentioning the date. Can you tell me by reading the question, what is the date when the question needs this data of group retained earnings and NCI? What should be the date? On what date the question needs the balance of group retained earnings and non-controlling interest? Tell me, guys. It should be, what says? Presentation in the consolidated statement of financial position. Now, when are we preparing consolidated statement of financial position? On 31st December 20x8. Okay, 31st December 20x8, because this is the reporting date, right? So this is 31st December 20x8. Now Gufran has a query. Sir, the impact of addition of this 2100 should be in console reserves rather than console RE. Very good. I totally agree with you. And I will show how this will happen. I will show that. I will prove that also. You are totally correct, Gufran, here. But what I am doing here is we are analyzing the profits. Right? So that's the reason I am just writing it off here for the completeness perspective. Okay. But when I am preparing the console RE, I will not include this amount. When I am preparing the group retained earnings, I will not be including this amount. Okay, in the group retained earnings, I will not be including this amount because it will go to group revaluation surplus. Okay, or it will go to group other equity, not retained earnings. Okay, is that clear, Gufran? Okay, wonderful. Now, so what is the question asking for? Group retained earnings and non-controlling interest. So let's come here. So let's write here requirement number B. Requirement number B. Okay. Now, what is the requirement number B? The requirement number B talks about point number 1. Requirement B, point number 1. Okay. It requires you to calculate value of NCI on 31 December 20x8. Now, how will you calculate that? So what is the value of NCI on date of acquisition? What is the value of NCI on date of acquisition? So we have already calculated that. So let's link the figure from there. NCI on date of acquisition is this much. Right? Now further, what is the post acquisition revaluation gain, and what is the post acquisition share of profit? Okay, share of profit. Now, so what is the post acquisition revaluation gain? It is 2100 is equals to 2100 multiplied by 0.25. Okay, this is post acquisition evaluation gain. What is the post acquisition share of profit? It is this much, 5250 multiplied by 0.25 minus how much? This much. This is 788. Now tell me, is that clear, everyone? Is that clear, everyone? Tell me, guys, come on. Now further, less what? Just write here less. We are not closing this account. We are not closing this account. We are not closing this account. Okay, but just write here less and leave one more line and write here NCI on 31 December 20x8. Okay, and just do the figures sum. Okay, just do it this way and keep it off. Okay, we will come back to these things. Hers, tell me which part you want me to explain. See, what we have done is we have two options. Either I can take only 5250 into 0.25. I can take it off here. Okay, as 1312.5. I can take it off directly that one also. I can take it off directly that one also. Okay, I can do that. I can do that. Okay, but what happens? But the question is asking for what? Tell me. Question is saying you have to calculate NCI. Now what I did here is, for the better presentation, okay, what I did here is I told that, see, this 2100 is coming here, and now 5 to 500 minus 2100 multiplied by 25%. See, this is what I have done. Is it clear? Or you can write here, simple, you can write here, remove this line, or if this line is creating confusion, so you can remove this line and just simply you can write here this way. Okay, the share of profit is this minus this multiplied by 25%. Done. This is also correct and you will get full marks for it. This is also correct. Tell me, is it clear, everyone, till here? Is it clear, everyone, till here now? NCI is clear to everyone till here? Wonderful. Now I am moving on to the next requirement. Requirement number, right? Let me write here. B, part number 2. And what is the part number 2? Group RE. Group RE on this date. Group RE, group retained earnings. Now, so for calculating group retained earnings, so now what is, first of all, I'll take the balance of retained earnings of Dorit, DORRET, on 31 December 20x8. What is the balance of RE of Dorit on 31st December 20x8? What is the balance? Is equals to, what is the balance? Okay, it will be given in the question. So let's go to the question. Question. See here, 22050. So let's write here 22050. But now you have to be very careful here, guys. It is as per the formula only. It is as per the formula. $1 on account of rounding off. Please ignore it off, Vishali. Okay, $1 on account of rounding off. You can ignore it off. Okay, now RE of Dorit company, the parent company RE on the reporting date is this much. This is final. This is fixed. Now you have to be very careful here. When you are taking the post acquisition profit, of Twist company, you have to be very careful here. How? Why? See, is equals to, what you have to do is, see this here. Come on here. Gufran, your point will get covered here. This 5250 is including 2100, which will go to revaluation reserve. So I will have to exclude 2100. I will have to exclude 2100. I will have to exclude 2100, right? I will have to exclude 2100. Okay, why? Because this 2100 will go where? Will go where? In the revaluation reserve. If you want me to show, I can show that also. Just wait a minute. I will show that also. So you can write here RE and you can write here R revaluation reserve. Okay, now what is the balance of revaluation reserve? 6000. Though it has not been asked in the exam, though it is not asked in the question, in this question, it is not asked in the question. I am just doing extra work. It is not asked in the exam. I am doing some extra work. It is not asked in the exam. I am doing some extra work. Okay. Now, so you can write here 5250 minus 2100 as here this one now is equals to 2100 into 0.75. So this is how we have to show. Now see, this 5250, if you just multiply this by 75%, how much comes? This multiplied by 0.75 comes to how much? 3938. This comes to 3938. And now how much we have taken? If you just add it, is equals to this plus this is 3938. So total is same, but we are presenting the revaluation gain on the property in revaluation reserve and other gains in retained earnings. So Gufran, your query gets answered here. Is that clear, everyone? Is that clear, everyone? This is not required in the exam. In this question, this is not required. Only retained earnings is required. Okay, I am doing something extra here. Is that clear, everyone? Tell me, guys. Come on. Dakshesh, see, in this 5250, this 5250 is what? It's a post acquisition profit. This post acquisition profit includes 2100 on account of property revaluation gain. Okay, now so now what we have to do is, so this 2100 multiplied by 75%, that is for me, will go to revaluation reserve. This 2100 multiplied by 25% will go to NCI. Okay, now for the remaining, that is 5250 minus 2100 multiplied by 75% will be my group retained earnings. Now rest will go to NCI. See this is what I have done. But in NCI, we don't have a breakup of retained earnings and other comprehensive income. It is simply NCI. So I have not done the breakup here. But when we talk about the parent contribution, parent share, when we talk about the parent share, we do have to show the breakup into revaluation reserve and retained earnings. Is that clear to all of you now? Tell me, guys. Is that clear to all of you? Dakshesh? We can't do directly in NCI and RE, not taking HTNA. Riddhi, if you have to do that way, then there is no need for this. There is no need for this itself, right? In that case, there is no need for this itself. In that case, there is no need for HTNA, right? But what I'm trying to do here is, if you prepare this, the things become pretty much clear. Okay, let me tell you the one point. If you don't prepare this, okay, it's not the case that you will not be able to solve. You will be able to solve, but the chances of making a mistake will become quite very high, because see what happens here. If you present it here, you can see the overall impact of a thing. You can see the overall impact of everything. Okay, but if you just try to individually, if you try to give the impact, there are chances that you will miss the transaction itself. There are very high chances that you will miss the transaction itself. Is that clear, Riddhi? Is that clear? So please do not do that in the exam. Okay, now, so this is done. Now what else? What else will come in the group retained earnings? Tell me. Come on, guys, tell me what else will come in group retained earnings? What else will come in group retained earnings? Tell me, guys. Just read the adjustments and tell me. So first adjustment I have not yet discussed. Second adjustment is already accounted for, no further treatment. Third adjustment is already accounted for, no further treatment. Third adjustment is impairment loss. So let's write less goodwill impairment. Now, since the NCI is at fair value, goodwill will be impaired and the impairment loss of goodwill will be recognized in parent share and NCI share proportionately. Goodwill impairment. And what is the amount of impairment of goodwill? So you can write here is equals to 1800 multiplied by 0.75 minus. Okay, similarly you do this here also, you recognize here also goodwill impairment, NCI here also you recognize, copy paste, right? So how much is equals to 1800 into 0.25. Is it clear, everyone? Is it clear, everyone? Is it clear, everyone? Now, what else will come in group retained earnings? We had deferred consideration, right? So unwinding of the deferred consideration. So right here, finance costs on deferred consideration. Okay, now can I ignore this part? Can I remove this part? This was just for understand. This was just for explanation. Okay, I don't want to show it off here. This was just for explanation. So I'm removing this part. Now, what is the deferred consideration? So the deferred consideration is what was the present value? What was the present value? Tell me, what was the present value? Present value was 6125. 6125. So 6125 into 0.08 divided by 2, because for the half year we have to calculate, right? So it is 245. So minus 245 is the answer. Minus 245 is the answer. Okay, so just you can remove. Okay, is that clear, everyone? Now tell me, is it clear, everyone, till here? Is it clear to everyone till here? Leave one line and write here what is the so just write here group RE on 31st December 20x8 equals to sum this way 22818. Tell me, guys, is that clear, everyone, till here? Is that clear, everyone, till here? Now see, we have discussed everything. Okay, we have discussed everything for part A, part B, but now except for this part, shall we start discussing this part now? Shall we start discussing the transfer of PPE now? Let us discuss. Now tell me, when the parent company, see who is transferring, see immediately after the acquisition of Twist company on 1st July 20x8, Dorit company transferred a item of plant with a carrying amount of 3 million to Twist company for an agreed price of 5 million, meaning thereby the Dorit company, the parent company, transferred a non-current asset, a property of 3 million to the subsidiary at 5 million, meaning thereby earning a profit of how much? Earning a profit of how much? Tell me, how much profit did parent company earn? 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 Come on, guys, tell me. How much profit did parent company earn on this one? Shall I discuss this in my using everything in my notepad? Shall I discuss this adjustment in my notepad? Only this adjustment? Okay, just give me a minute. Okay, let us discuss this adjustment. Now, what does it say? Immediately after the acquisition, Twist company, now, so there are two companies, Dorit and Twist. Dorit being the parent company and Twist being the subsidiary company. So Dorit had an asset, a property which had a carrying amount of $3 million, which it sold to Twist company, at a price of sale price was 5 million. Now in their individual financial statements, they would have recorded something like this. Tell me yes or no. They would have recorded something like this. He would have recorded a profit on sale of 2 million. Tell me yes or no. He would have recorded a profit on sale of 2 million. Tell me yes or no. The parent would have recorded a profit on sale of 2 million, right? The Twist company would have recorded a depreciation, excess depreciation, would have recorded an excess depreciation for this 2 million. How much? 2 million. The life was 2.5 years, and in the current year we have spent only half year, right? So how much? 2 divided by 2.5 into 0.5 is 0.4 million, right? Tell me yes or no. Excess depreciation he would have charged in the books. Tell me yes or no. This would have been done in the individual financial statements of the respective companies. Okay, this would have been done. I am writing here again. This would have been done. Okay, in separate financial statements of respective companies. Tell me yes or no. Tell me yes or no. Now after acquisition, okay, and on the reporting date we are saying that when we prepare the group accounts, we are saying that the parent and subsidiary is one. If the parent and subsidiary is one, can they realize the profit from each other? Tell me, can they realize the profit from each other? Don't you think it is just an overstatement of the asset, overstatement in the value of the property? Don't you think it is just the overstatement in the value of the property? It is just the overstatement in the value of the property, right? So what we have to do? We have to eliminate this. We have to eliminate the impact of both of them, right? So we have to eliminate the impact of both of them. Now this profit on sale is recorded by whom? Which company? Parent company. Okay, so reduce parent company's profit by 2 million. Now this excess depreciation would have been recorded by which company? Subsidiary company. Okay, now what will I do for this one? Increase. Okay, this would have reduced the profits, so increase subsidiaries profit post acquisition by 0.4 million. Tell me guys, is it clear everyone till here? Is this part clear to all of you? Is this part clear to all of you? And as a net impact, what will happen? Okay, fine, I'll explain. But tell me, is this clear everyone till here? Is this clear everyone till here? Okay, now what is the journal entry of this? What are the journal entry of this? So journal entry of this is, the journal entry of this is console, or I write here group RE account debit to PPE. How much? 2000. What is journal entry of this? What is journal entry of this? Journal entry of this is a PPE account debit to statement of net assets post period by 400,000. Tell me, is the journal entry clear to all of you? Is the journal entry clear to all of you? Now coming back to our discussion in the questions. Tell me guys, is this a treatment of transfer of PPE, the unrealized profit on transfer of PPE, is that clear? Profit on transfer of PPE, is it clear to all of you? The treatment is clear. Now let us make the treatment, let us do the treatment here, let us do the adjustments here. So goodwill part, no, here, right? So first of all, here I will do in the group RE, I will do less what? Okay, profit on a transfer of property. How much? Negative 2000. Okay, negative 2000. And here I am not explaining everything. I will just, okay, let me explain. 5000 minus 3000. 5000 minus 3000. Okay, now further, here what I will do here, see, I left one line item here, right? So I will write here add excess reversal of excess depreciation on reversal of excess depreciation. That's all. Okay, fine. Now what is the amount that will come up here? What is the amount that will come up here? Just a minute. Amount will be 2000 divided by 2.5 years, okay, multiplied by 0.5 year, that is post acquisition period. Okay, now what is the treatment that I will give here? Here I will write here plus 400. I will increase the profits. Now tell me, is it clear everyone? Is it clear everyone? Come on guys. Why 2000 is reducing the 2000 is reducing the SP is higher than the carrying? Mr. XYZ, parent company has already transferred at a profit. Okay, so we are eliminating this profit. Okay, that's why we are reducing it. Okay, the parent company has already recognized this profit, right? So we are eliminating this profit now. Okay, that's why we are reducing. So now this will have a consequential impact here. So this is your NCI. This is the value of your NCI. This is the value of your NCI. I hope it is clear to everyone. I hope it is clear to everyone. Come on guys, please confirm. Is it clear everyone? Is it clear to everyone? Okay, Nishan, you had this query. Is this query cleared now, Nishan? Wonderful. Wonderful. Now, so this completes our treatment of Group RE, NCI, and the investments and everything. So we have successfully covered 4 plus 8, 4 plus 6, 10 marks. 10 marks fully completed. Tell me, guys, in this 10 marks, anyone has any queries? Are you able to understand this? Are you able to understand this? Some confusion. Tell me what's the confusion, Nishan. Tell me what's the confusion. I will remove all the confusion. Tell me. So first of all, the parent, the company who sells, we have to reduce the profit from their books. The company who has purchased the PPE, I have to reduce the excess depreciation from their books. That's all. Simple. It is simple. It is simple. The company who sold the asset, I have to reduce the profit from their books. The company who has purchased the property, I have to reduce the, I have to reverse the excess depreciation in their books. Okay. Still, if there is some confusion, do let me know. I will help you with that. Okay, now moving further. No more adjustment required for the plant. Okay, though the question is not asking for, sir, but shall I ask one question? Shall I ask one question? Though the question is not asking, what should be the carrying amount of plant to be reported in consolidated FS on 31 December 20x8. Can anyone answer this part? Let me see who can answer this part. Okay, so first of all, find what is the carrying amount of plant in the books of subsidy. In the books of subsidy, what was the carrying amount of plant? Okay, what was the carrying amount of plant, not plant. Okay, on the plant. Okay, so it will be 5 million 5,000 minus 5,000 divided by 2.5 years. Okay, divided by 5,000 divided by 2.5 years multiplied by 0.5 year. It is 4,000. Tell me yes or no. Tell me yes or no. Right, now further what we have to do, we have to less profit on sale. Okay, how much? Minus 2,000. Minus 2,000. Right, now add excess depreciation. Okay, charged. Okay, sorry. Add reversal of excess depreciation. Okay, is equals to how much? 2,000 divide 2,000. Okay, I'll write here just simply. I'll write here plus 400. Plus 400. So is equals to sum 2400. 2400. Now if I have to calculate this in a simple manner, meaning thereby what should have been the carrying amount of the asset if the asset was not transferred at a profit, meaning thereby in a simple language, if you want to transfer, if you in a simple language, it should be it can be calculated in this manner: 3000 minus 3000 divided by 2.5 multiplied by 0.5. This should be the carrying amount of plant. That's all, nothing else. Nothing else, nothing else. That's all. 2400. Meaning thereby we are just eliminating the impact of profit charged. We are just eliminating the impact of profit charged. We are just eliminating the impact of profit charged. We are just eliminating the impact of profit charged. Is it clear, everyone? Tell me yes or no. Is it clear, everyone? Tell me yes or no. Come on, guys. Nishan, Hers, Swam, Dakshish, Yash, Gufran. This will be the carrying amount of plant in the console FS, group FS. No, but in the exam, if it comes, you are not required to show this detailed working. No, you are not required to do that. You can simply write this also. You can simply write this way also. Okay, you can simply write this way also. But though they will not ask you to show the working detail, okay, you just need to. They will just ask you to calculate the carrying amount. Okay, in the SOFP, in the console SOFP, they will ask the group SOFP. They will ask. So you can calculate and write it off. Simple, simple. Okay. So I'm removing it off from here. Sir, I deducted 2000 from the SFS and added 1000 the cost. No, Pooja, that is wrong. That is wrong. You will not do any adjustment in SFS. You will not do any adjustment in SFS. These adjustments are being done in console FS. Delete. Delete. Now the requirement number third part, requirement C. You have to prepare console P&L. You have to prepare console P&L for the year ended 31 December 20x8. Console P&L. Okay. Now, so what I have discussed with you, how to do that. So first write Dorit, then write twist multiplied by 6 by 12. Okay, then further any other adjustments, and then group, and then you will write group PL, then you will write group P&L. So this is how you have to solve. This is how you have to solve. Okay, so now just give me a minute. Now, so this is this one now. So let's first of all what I will do is we will make the structure. We'll make the structure. Okay, how to structure the structure is revenue, cost of sales, then gross profit. Now, so just come to the P&L and use this structure only. Use this structure. Okay. So rather than typing everything, just copy, paste. Okay. Sorry, it's not copy paste. Delete. Just a minute. Ideally, it should get copy pasted. Copy. It should get copied, but I think the system is showing some errors from my side. It should get copied ideally. So let me write it off. Distribution costs, then admin expense, then finance costs, then profit before tax, PBT, profit before tax, then income tax expense, okay, then profit after tax, then other comprehensive income, then revaluation gain, then total comprehensive income. Why I am preparing P&L? In the P&L, though I have discussed each and everything now, I don't want to take it off, but I want to just discuss one point. I just want to discuss one point. Okay, that what is the point that I want to discuss? Allocation of the profit to parent and NCI. Okay, now Dorit company, just can you please help me with the figures? Okay, so first of all, for Dorit company, we'll write exactly. For Twist company, I will do 6 by 12 multiplied with the time adjustment I will do. Then I will discuss the adjustments and then I will prepare the group P&L. Okay, so firstly, let's write it off. 222. Okay, then minus 161500. Then is 60. This I'll calculate. Then 6900 minus 6900. Then minus 13100. Then minus 800. Then okay, sorry. Income tax expense is how much? 10,750. 10,750. Then what else? Here is 5050 is revaluation gain is 5050. 5050 is the revaluation gain. Okay, fine. Now further Twist company. So Twist company, remember we have to do time adjustment. So for the subsidiary company P&L, we have to do time adjustment. Okay, now so what is there? 104900 into 6 by 12. Okay, then equals to minus 83900 divided by 2, right? Then distribution costs is how much? 4200. So minus 4200 divided by 2, right? Then 6300 minus 6300 divided by 2. Come on guys, do on yourself also. Don't rely on me. Don't rely on me. Minus 3500 divided by 2. Okay, then what else? Profit for the year, done. So P&L format is done. So let's complete the structuring also. Sum this plus this, then PBT is equals to sum then PAT is equals to sum then other comprehensive total comprehensive income. I didn't write. Total comprehensive income is equals to sum is equals to 34,000. Correct, right? Now just copy this formula here as well and here as well. Okay, just copy this formula here and here as well. Okay, copy and paste. Copy and paste. Then copy and paste. Right, see 3500 profit come. 3500 is the post acquisition profit. That's what we discussed there also. So now tell me, till here is it clear everyone? Till here is it clear everyone? I have not done anything. I have just done the time adjustment and copied. Tell me, is it clear everyone? Till here is it clear everyone? Please confirm guys. Wonderful. Now any adjustment, let's start from here. Start from the top and read and tell me any adjustments. So this is about the Dorit company share acquisition. So no impact in P&L. Cash consideration, finance cost impact will come here. So it will increase by 245. Deferred consideration unwinding, right? It will increase deferred consideration, unwinding will increase the finance cost, right? So what will happen? The finance cost will be this here. Then further any other adjustment here in this paragraph? No other adjustment. Come on, let's move further. Let's move further. This all these things done, done. Yeah. Now here. Any specific adjustment? Tell me for this part. See, this is the profitability of, this is the P&L of the parent and subsidiary both. This is the parent now. So for this one, what we have to do? We have to eliminate 2000 and we have to reverse the depreciation of 400. Now tell me what they have done. So it says the profit on transfer as a reduction in depreciation cost, and all depreciation is charged to cost of sales. So what they have done, they have the 2000, the profit which is earned by the parent company is adjusted with the cost of sales. This would have reduced the cost of sales. So what I will do, I will increase the cost of sales by 2000. Why I am doing minus? Because the cost of sales is in minus. To increase, I have to do further minus. Right, again minus. Okay, so you will write here minus 2000. You can write here profit. Okay, minus 2000 profit. Now further, this excess depreciation which we have to reverse, means depreciation we have to reverse, means profit we have to reduce. Means excess depreciation we have to reverse. Depreciation reverse means we have to reduce the tell me depreciation cost. We have to reduce the depreciation cost, means we have to reduce the cost of sales. To reduce the cost of sales, I will have to do plus 400. Okay, reversal of excess depreciation. Is that clear everyone till here? Guys? I am reversing the excess depreciation on this profit that is charged by the parent company. Okay, now this is done. This is done. Part number 1 is done. So let's strike it off. Done. No other treatment to be done here. Coming to this part, 14 million is the fair value adjustment on the date of acquisition, no impact on P&L, but 350 million is the excess depreciation that we need to charge. So that will increase my cost of sales. So minus 350 excess depreciation that we need to charge. Minus 350 is the excess depreciation that we need to charge. Tell me guys, is it clear everyone till here? Wonderful. Now, so this is also sorted. So let's strike off this also. Okay, now this is also sorted. Then what? 2100 is the revaluation gain. So let's write here plus 2100 revaluation gain. Okay, so fine, done. This is also done. Now third part, impairment of goodwill, admin expense. So minus 1800 goodwill impairment. Done. P&L done, sorted. So let's close it off. Is equals to this plus this. P&L done is equals to this plus this minus 2000 plus 400 minus 350. 70850. Shall I leave this question in between, Mr. XYZ? Do you want me to leave this question in between? To 45. Okay, done. So this is your this part. Now income tax expense is how much? Equals to this plus this. Done. Okay, 29210. Is that clear, everyone? Tell me, guys. Is that clear, everyone? In cost of sales, you wrote 2000. Now is it clear, everyone? Now is it clear, everyone? Tell me, guys. Is it clear, everyone? Just confirm that if it is clear, everyone, do let me know. Let me. Okay, there is some mistake in the formula part, I believe. There's a mistake in the formula part. It will be 49. It will be 49. Okay, fine. Now it is correct. It is correct. Okay, so that's why other first difference. Formula correct. Formula correct. Formula correct. Right. Is it matching with the answer? Is it matching with the answer? 35605, right? 35605. Correct. Perfect. 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 Now what we have to do is allocation. We have to show the allocation. We have to show the allocation. Guys, why I'm spending so much time in this question? Because it serves as a revision of your group accounts also entirely. So if you are noticing it, I am actually explaining each and every topic by the help of this question, right? If you are noticing it, I am explaining each and every concept and the topic by the help of this question. So it serves as a revision also, right? Now allocation of profit. Allocation of profit to whom? To owners of the company and non-controlling interest Okay, now for that further you can write a copy, and then again allocation of total comprehensive income. Allocation of total comprehensive income. Total comprehensive income. Okay, again, so let's prepare working note. Okay, prepare working note. Okay, working note for allocation of profit. Allocation of profit to NCI. Now tell me, what is the profit what is the profit earned by subsidiary? What is the profit earned by subsidiary? Because the NCI will take the profit only from the subsidiary, not from the parent. Okay, so what is the profit earned by subsidiary? Is in the post acquisition, in the post period, multiplied by 6 by 12. Okay, so the profit earned by subsidiary was 7,000 multiplied by 6 by 12 is equals to multiplied by 6 by 12, right? Now what we have to do? Tell me what we have to do now. So what are the adjustments that we have done to the profits of the subsidiary? Now this 2000 profit, tell me, is it adjusted in the profits of subsidiary? No. This 400 This 400 and this 350, yes, they are adjusted in the profit of subsidiary. So let's adjust it off here. So whatever is the adjustment, that impact the profit of subsidiary company, we will adjust here. Okay. So let's write here. Reversal of excess depreciation. How much? 400 plus. Okay, then excess depreciation on fair value adjustment. Excess depreciation on fair value adjustment, that is minus 350, right? Then goodwill impairment. Since the NCI is at fair value, goodwill impairment will also come here. What is the amount of goodwill impairment? Negative 1800. Negative 1800 is the amount of goodwill impairment, right? So this is the adjusted profit. Adjusted profit of subsidy. Now what is the amount? Is equals to sum 1750. Now further add revaluation gain. Revaluation gain is how much? 2100, right? So right here adjusted total comprehensive income of subsidiary. So what is the amount here? So the amount here is equals to this plus this. Now what is the NCI share? NCI share is this multiplied by 25%. Okay, this multiplied by 25%. Now copy and copy. Okay, so now this is the amount. So right here, what is the amount allocation of? I'll write here, right? I will write here. TCI will be 963 and TCI will be, and profit will be for NCI. Profit for NCI will be 438. Now what about this one? The owners, it will be balancing figure. So tell me, what is the profit earned by the total company? 28455 minus what is the amount attributable to NCI? 438. So this is 28018. Now what is the profit earned by total comprehensive income earned by the group? Total comprehensive earned by the group 35065. What is the amount attributable to NCI? 963. This is the amount for 34643. Tell me, is it clear, everyone? Is it clear, everyone? Is it clear, everyone? So if you solve this much, yes, you will get 20 marks for this. You will get 20 marks for this. Tell me if anyone has any doubts now. I am ready to discuss. So this is what we did. This is what we did for the group. So I believe this discussion on the question also served the purpose of revision. Also served the purpose of revision of the group accounts, right? Very good, very good. Now coming to the next question. So the next question is for the interpretation. The next question is for the interpretation. Now interpretation, rather than writing here, because interpretation I need to explain you guys. So rather than solving interpretation here, can I solve in my OneNote? Rather than solving interpretation here, can I discuss in my OneNote, in my notepad? Okay. So moving to my notepad. moving to my notepad. This is question number 32. This is question number 32. Okay, this is question number 32. Now, do you want a break? Shall we take a break of 5 minutes and then resume back? Shall we take a break of 5 minutes and then resume back? Okay, so let's break up for 5 minutes and then we'll resume back. Okay. Let's resume, guys. Come on, resume back. Don't give any time to learning anything, just give time to practice and reading. That's all. The only last minute tips for SBR is practice and read as much as you can. That's all, nothing else. So this is question number 32, which pertains to interpretation for the pre-mock exam. Okay, now, so it says that the following are the extracts from the most recent financial statements of Griffin Company, a public company. A statement of P&L for the 31st December is given, okay, 20x8 and 20x7. 31st December, 20x8 and 20x7 is given, means previous year and the current year is given, okay. So prima facie, it appears to me that we have to compare the 2 years profitability. Prima facie, it appears that we have to compare the 2 years profitability, okay. Now, statement of financial position as on 31st December 20x8 and 20x7 is given, okay, fine. Now, the question gives you P&L for 2 years, SOFP for 2 years, okay. Now the question says that based on the Griffin Company's financial statements extracts, the following ratios have been calculated for the year ended 31st December 20x7, meaning thereby for 20x7 the ratios are already given. The ratios are already given, okay. Now this is given based on the P&L or the SOFP, okay, it is given, okay. This is the ratios for 20x7, sorry. Now, by end of 20x7, it says by end of 20x7, Griffin Company concluded that one of its division was no longer good fit for the company's strategy. On 1st January 20x8, Griffin sold the net assets. Okay, including goodwill of the division, which had been independently operated, for $19.2 million cash, on which it made a profit of 2.4 million, okay. So meaning thereby it says that the financial statements of 2 years are given, right? It says that the financial statements of 2 years are given, right? Now it says that for 20x7 and for 20x8. So in 20x7, it was held for sale, but we have not yet sold, okay. It was a discontinued operation, held for sale, but yet not yet discontinued. But here in 20x8, okay, I have sold it off, So meaning thereby, okay. Now this is what is the question saying. Okay. Now sold for what price? Sold at 19.2 million. Sold at 19.2 million. Then at a profit of 2.4 million. Then what should be the carrying amount of the division? 19.2 minus 2.4 is 16.8 million. Is 16.8 million. Okay, fine. The division reported the following results for the year ending 31st December 2007, which have been included in the Griffin Company's SOP&L. Okay, it says the division which was discontinued report for the previous year. Since in the current year, since it was discontinued, it was sold on the very first date itself. For the current year, that is 20x8, it was sold in the very first day itself. So it will not show anything. But in the previous year, it will show a revenue, cost of sales, operating expenses, finance cost, profit before tax, tax expense, everything it will show. So it says that for the previous year, that is 20x7, for 20x7, 31st December 2007, revenue of this is the data given for the division sold. Now, the following is the list of the comparative industry averages. Now, the question is giving you the industry averages. Okay, what are the industry ratios for the previous year and for the current year? What is the industry ratio? Now, what is being asked? Calculate equivalent ratios to those in note 1 above for 31st December 30 for the year ended 31st December 2008, excluding the profit on sale of the division. Calculate the equivalent ratios for those in note 1 above for the year ended 31st December 2007. Means 2007 and 2008 both I have to find. Then you will ask, sir, 2007 was already given in the question. The ratios for 2007 was already given in the question. Now see, excluding the contribution made by the division that has been sold, meaning thereby excluding the impact of this one. Find the ratio of 2007 excluding the impact of this one, excluding the impact of this one. Okay, fine. So then you have to analyze. So first of all, shall we find the ratios? Shall we find the ratios? Tell me. First of all, shall we find the ratios? So let's come and find the ratios. So requirement number. What is the requirement number? A. Requirement A. Right here, part 1 and part 2. Let's solve together. Let's solve together. Now, what are the ratios? What are the ratios? Just see the name of the ratios. ROCE, gross profit, operating profit, interest cover, net assets turnover. So let's write here. Return on capital employed, then GP margin, then operating profit margin, then what? Interest cover, then what? Net assets turnover. I believe you guys already know the formula for all of these. You guys already know the formula for all of these, right? So the formula, if you want me to write, still I can do that, but I believe you already know it off, right? So ROCE, the formula is operating profit divided by capital employed. Gross profit margin is gross profit divided by revenue multiplied by 100, right? Operating profit margin multiplied by 100 here also, 100%. Net operating profit divided by revenue multiplied by 100%. Now interest cover is, tell me what is the formula for interest cover? Tell me. Profit before. Tell me what is the formula. Let me see who can say this formula. Come on guys, tell me what is the formula for interest cover. Waiting for your answers. Formula for interest cover and formula for net assets turnover. I wrote 3 formulas, 2 formulas you can give me. PBIT by finance cost. Very good. Operating profit divided by interest costs. Okay, operating profit means profit before interest and tax. Okay, now net assets turnover is, tell me what? Right? Tell me, is it clear, everyone? Now, so let's calculate the. In the exam, do we need to write the formulas? No, we are not required to write the formulas. Guys, also I will tell you one thing. Where is that file? I kept it somewhere, kya? Okay, I am preparing a list of common mistakes which a student does in the exam. Okay, most probably by tomorrow I will come up with a video on that. Okay, these are the commonly made mistakes for ACCA financial reporting, which I will make a video max of 5 to 10 minutes, which you can watch it off. Okay, so in that I will say that no need to write formula unless specifically asked in the question, unless specifically asked by the question. Okay, now. So ROCE, return on capital employed. So tell me, what is the ROCE for 20x8, 20x7 and 20x7, that is given in the question. Okay, adjusted 20x7, adjusted 20x8. So let's find it off. So operating, so first of all we'll go one by one. So first of all we'll calculate everything for 20x8. We'll calculate everything for 20x8, then we'll calculate everything for 20x7 adjusted. Okay, we'll go one by one. We'll go one by one. Okay, 20x8. First of all, calculate everything for 20x8. Now tell me what is the profitability for 20x8. Can you help me with the in the ratios, guys? I think ratios is your duty, not my duty. Ratios are your duty, not my duty. Come on, guys, to calculate the ratios one by one partially. I believe you already have the questions with you. So please tell me the ratios. P and L. First was this one. So it will be, I'll take 10320 and revenue is 87,300. 10320. Okay, I do have the question. I will refer this question and I will keep on writing the formulas. Okay, but you also do it off with the question that I have. I am solving it off. So it will be 10320 plus 10. Okay, plus 10. This will give me my PBIT. Then minus 2400. It is a profit on the disposal. It is a profit on disposal. Okay, divided by what is the capital employed? What is the capital employed? 54,000 minus 13,000. 54,000 minus 13,000. So it is 54,000 minus 13,000. Okay, now calculate it off. Let's come to gross profit margin. So gross profit margin has no impact of the sale on disposal. So it is plain vanilla only. It is plain vanilla. For 20x8 adjusted is equals to, what is the gross profit margin? It is, gross profit is 2800 by 87,300. 28,800 28,800 divided by 87,300. Okay, not here, sorry. 28,800 divided by 87,300. Right now, operating profit margin for 20x8 for 20x8. Shall I do one thing? Shall I do one thing rather than solving this one? Shall I take up the already solved answer and explain that one? Shall I do this thing? I think that will be better, right? I think rather than solving, it will take unnecessary lot of time and just the calculation, and it is just the calculation, nothing else. And it's just the calculation, right? It will take a lot of time. So I'm just ignoring all of this, whatever calculation are. I don't want to do the calculations part. Just give me a minute. Okay, I will just paste the question and solution and discuss that off. Okay, because it will not make any sense and it will waste a lot of time. Insert. Just give me a minute. I think my solution is also somewhere else. Just give me a minute, guys. Just give me a minute. Hmm. So solution is with us. Let us discuss the solution. Now, further it says that 10320 is the, see, this is how their capital return on capital employed, gross profit margin, operating profit margin, interest cover, net assets turnover. Okay, this is what they have done. But now understand, I believe this calculation per se you can do it off. This calculation per se you can do it off. But the certain challenges that you will face in this calculation, I will tell you. In 20x8, what you have to do is you just need to remove the impact of, impact of profit on disposal. That is how much? 2.4 million. Now in 20x7 adjusted, remove the impact of revenue, costs, distribution expenses, admin expenses, okay, then interest, then tax, everything of the disposal group, okay, the group which will be the division which will be disposed, okay, of disposal division, okay. Now from the P&L, now further from the asset side, that is when calculating the capital employed, what you have to do is you have to reduce capital employed by 16.8 million. And what is the 16.8? It is the carrying amount of the division disposed. How did I arrive at the 16.8? So the question says that 19.2 million is the sale price of the disposed division, and the profit on the disposed division is 2.4 million. So the net carrying amount of the disposed division is 16.8 million is the net carrying amount of the disposed division. Okay. Now on the basis of these two discussions, you can calculate the ratios, I believe. Tell me, is the ratio calculation part, can you do it off? Ratios calculation part, can you do it off? Tell me guys, come on. Ratio calculation part, can you do it off? See, they are explaining the calculations. Figure of 20x8 are derived from the equivalent figures in the question. However, ROCE, operating profit margin, and interest cover calculations exclude the profit from sale of the division. For 20x8, it excludes the profit from the sale of division. And what is the profit from sale of division? 2.4 million. Now, the capital employed in the division sold at 31st December 2007 was 16.8, that is 19.2 million sale proceeds less 2.4 million profit on sale, right? So it is 16.8 million. So this is the explanations that they have given for the calculation part. So I believe considering this ratio part, you can calculate. Now how to do the analysis? So now coming back to the question. So this ratio part, see, it is a free marks that is given to you, free marks. How much? 8 marks given for free, because calculation of ratios are something which I believe all of you can do it off. Why in ROC 2000 profit is not removed from capital employed? Nishan has a query. Why in return on capital employed 2400 profit is not removed from capital employed? Okay. Tell me, what is the meaning of capital employed? Nishan, what is the meaning of capital employed? Capital employed, basically it means that what is the net assets. So we calculate total assets minus current liabilities. We calculate, okay, total assets minus current liabilities. Now so when arriving at the capital employed of 20x8, so the capital employed that we calculate, that is this one, that is 54,000 minus this one, 54,000 minus 1300. This is the net carrying assets, net assets of the company without the division which is disposed. This is the net assets of the company, Griffin company, without the disposal group, without the division which is disposed. Now further, in this year, this was the total assets, this was the current liability, and this is the carrying amount of the asset disposed. This is the carrying amount of the asset disposed, right? So we already adjusted in arriving at 16.8, we took 19.2 minus 2.4. So it is already adjusted for. So we are not required to adjust any further, Nishan. Okay. Is that clear, everyone? Nishan, is it clear to you? Nishan, is that clear? Now, before I move on to my analysis part, before I move on to the analysis and the interpretation part, tell me, guys, I asked you, all of you, to solve this question paper. So I assume that you guys have solved this question also. So now tell me, any of you, how many of you got 8 out of 8 in this part? How many of you got 8 out of 8 in this part? Or rather than asking this question, I will change my question. Any of you have any queries in the ratio part? I will just discuss that query and then I will move ahead. If you have any queries in the ratio part, do ask me and then I'll move ahead. Or if not, then I assume that all of you got 8 out of 8. Is it the case that all of you scored 8 out of 8 in this part? Come on, guys, tell me. Waiting for your responses. These explanations also carry marks? No. Ideally, no. But if you give these explanations, it will help the examiner. Okay. But if you have not given, it's totally fine. Gave the ratios correctly. Query resolved now. Hers, do we have to make the extract of P&L? No, it is not asked in the question, so not required to make the extract of P&L. Not required to make the extract of P&L. Okay, just if you have to show this way itself, you have to show this working, you have to show this working. So however they have shown here, the same way you have to show in the exam also, this way, same way. This explanations, if you can give, it's fine. If you cannot give, it's fine. Because they are not asking for the explanations. See, are they asking for the explanations? Calculate. Are they asking for explanations? No, they are not asking for explanations. They are not asking for the explanations. So is it clear, everyone? Tell me. Where is it given to explanation? Okay, yes. See here. Who is this? Nishan, very good. Your answer should provide explanatory notes for the calculations where appropriate. Yes, it is. Since the question is asking for, then yes, it is required. Yes. Thanks, Nishan. Thanks, Nishan, for highlighting the same. Since the question is asking for the explanations, then yes, it is required. But is it required for all the calculations? No. Wherever you think that you have done something additional, that profit or capital employed, all those things. Okay. Wherever you think it is required, that's all, nothing else. Okay. But if you ask me, I will say, as I have told in the group accounts also, and I will tell you here also, wherever you have done any calculation, show that calculation. Okay. Show the notes. Okay. Show that calculation. So now this 16.8 you have done. From where this 16.8 arise? You have to show the calculation. How does this 16.8 arise? Okay. Now let's suppose this figure is 16.8, but by mistake you calculated 17.8. So now here the figure of 17.8 is wrong. So you will not get marks for 17.8. But if you have just shown the calculation of 17.8 everywhere, wherever you have used 17.8, the answer is wrong, but you will get full marks for that. So that's the importance of showing the notes. Okay, so you have to in my view, always you are required to show the notes. Swam, we cannot predict anything about that. Okay, we cannot predict, but if you ask me, that's what I'm saying, that you are required to show the notes every time. If you ask me, okay, if the question asks you to prepare the calculate the adjusted ratios, and if you are making some complex adjustments, then show or write in 1 or 2 lines, not much, not in detail, just one or two lines what exactly you have done. Okay, just 1 or 2 line write about 16.8 or the profit. That's all, nothing. It's not required to write in this much detail, no, but at least 1 or 2 line if you can give wherever you have done the complex calculations, it is recommended even if the question doesn't ask for the same. Now tell me, can I move on to my analysis part? Now when you are doing this analysis, understand. So if you would have watched my interpretation of ratios and a chapter, I always asked you to show what if analysis. What if analysis I always asked, right? I always asked you to show what if analysis. Now tell me, just see the profitability. What happens? See, 53.6 reduced to 51.2, 51.2 further reduced to 19.3, 40.5 reduced, not much, but yes, it is reducing again. See, again reducing, right? So reducing, right? So basically what happens, when the division is disposed of, the profitability decreases significantly. So now see, what is the major transaction that has happened in the year? That we have disposed of the division. So the first thing that will hit our mind is this decrease in the profitability might be due to disposal of the division. Now see, read this part. The division sold was profitable, having a gross profit ratio of 40.8 and an operating profit ratio of 26.6. okay, meaning thereby the profitability of the division which we have disposed of, the division which we have disposed of has the profit margin in the same lines as to the profitability of the other divisions in the group, okay, other divisions in the company. Okay, see how come? See this, the gross profit ratio of the division is 40.8, and what is the gross profit ratio here? Gross profit ratio 40.3, more or less the same. Tell me yes or no. Now see here also, gross profit ratio and operating profit ratio of 26.6, operating ratio of 22.6, more or less the same. Tell me yes or no. More or less the same, right? So it is not the case that the division which we have disposed had a very high profit margin. Now since I have disposed of that division, my profit margin has reduced significantly. No, this is not the case. So the decline in the profit margin is not due to sale of division. The decline in the profit margin is not due to sale of the division. Why? Because now let's suppose, understand what I'm trying to say. Let's suppose this is the entire company, and now this is one of the division. This division earns a profit of 40%. The other part of the company also earns a profit of 40%. Now, if this is sold off, now my profitability will still be 40%. My profitability will still be 40%, right? Now, this is 40%, this is 40%, but this is not this 40, this is 60%, this is 60%, this is 20, the other department is 20%, overall it is 40%. Now if I sell this, my profitability will reduce from 40 to 20. Why? Because on the condition of average out, this was having a very high profits, but this is not the case here. Rather, this is the case here. The profit margin of the sold department and the unsold department and of the entire company is more or less the same. So decline in the profit margin is not attributable to the sale of division. Is not attributable to the sale of division. Okay, is that clear? So this is what they are writing in this paragraph. Okay, now further it says that though the profitability is decreasing, but in the previous year if you compare this with the industry averages, if you compare these ratios with the industry averages, they were significantly high. They were significantly high. Just see, the ROCE was 51.2, industry average for ROCE was 36, significantly high. The industry average for gross profit margin was 32. The industry average for this company had 40.3, 32 and 40.3, meaning thereby the industry, we superseded the industry averages in the previous year. In the previous year, excluding the impact of the division that is sold, the profit margin exceeded the this one, what we say as the industry averages. But now in the current year, see, current year my ROC is 19.3 and my ROC for the industry average is 35%. So now what is happening? I will write three statements here. See, I am writing here three statements. Profitability has decreased significantly. First point. Second point, the decrease is not solely attributable to sale of division. Third point, in 20x7, okay, entity exceeded industry average. In 20x8, entity not exceeding, entity is lower than industry averages. Entity is lower than the industry averages. Now what has happened? Why it is happening like this? See, the profitability in the previous year, I was exceeding the industry average. In the current year, I am below industry averages. Why so? And this is not due to the disposal also. Why so? So now for that you have to assess. This might be due to increasing cost of sales or increasing operating expenses, right? Now see, understand, even the gross profit margin is reducing, the operating profit margin is reducing significantly, right? So first of all, understand it is due to increasing cost of sales, first reason, or it can be due to any other reason not known to the entity, for which the entity needs to investigate further. Now then, why operating profit is reducing? First point, operating profit is reducing. Why? First point is carry forward impact of the reducing gross profit. Second point, if you just see here the P&L, here operating expense has increased significantly. See here, the operating expense has increased significantly. Admin expenses increased significantly. The admin expenses increased significantly, right? The admin expenses increased significantly, right? Now the entity needs to investigate further why this admin expense is increasing further significantly, right? For ROC, it could be that the capital employed is increasing or operating profit is decreasing. For operating profit is decreasing, that could be one of the reason. Capital employed is increasing. Where is capital employed increasing? Show me. Come to the ratio. Rather, I can say that the capital employed is decreased, not increased, decreased. Right? So that is not a reason. That is not one of the reason. Okay. Operating profit reducing is the reason. Reduction in the operating profit is the reason. And why the operating profit is reducing? Because the operating expense, the admin expense is increasing. Now we don't know why the admin expense is increasing. Might be due to the sale of the division. Some operating expense would have increased, right? Some operating expense would have increased. That though we don't have any concrete information about it, so the entity needs to investigate further on that. The entity needs to investigate further on that. Okay, further. So this is how you need to analyze the profitability ratios. Now further, what you see here. Now tell me, what was the sale proceeds? What was the amount of sale proceeds? 19.8 million. Now if you just come in the balance sheet, SOFP, if you just come in the SOFP, see what is happening. Non-current loan notes was reduces significantly from 19.2 to just 0.2 million. Why? So might be the case the entity got 19.8 million as sale proceeds, which entity used to repay the loan, and we can see the impact by reducing finance cost significantly. The finance cost has reduced significantly, right? So it might be the case that in 20x8, at the very beginning, that is on 1st January 20x8, I sold off the division, realized 19.8 and used that funds to pay off my liabilities, which reduces my liabilities and my finance costs also. But now understand, we always need to assess the return on capital employed and interest rate. Tell me, what was the interest rate on these loans? What was the interest rate on these loans? What was the interest rate? 5%. The interest rate was 5%. The interest rate 5. And what was the ROCE of the company? 19.3 in the current year. 19.3, meaning thereby, if the company would have not repaid this loan, rather used the sale proceeds in the business itself, so the business would have generated 19.3% return on that 19.8 million. Okay, out of which I can pay 5% interest, and still 19.3 minus 5 is 14.3%. Still is my net profit. Still would have been my net profit, right? So it is not the case that always the repayment of the loan is good. No, leveraging benefits should also be utilized. So though the entity has paid the loan and it has improved its gearing ratio, but rather than paying, if the entity would have used the funds in its own business, then the entity could have earned 19.8% return on that and paid 5% of 19.3% return on that and paid 5% finance cost, earning a net profit of 14.3%. That could have been done. Okay. Now, so this is what you have to write in the analysis. Then further you have to write the conclusion that the sale of division is not the only reason, but the profitability is decreasing, though we don't have the concrete information about why the operating expenses are increasing, or why the cost of sales are increasing. Okay, so entity needs to investigate further into that and find out the reasons why these costs are increasing. Okay, further we write the entity could have used the funds to in the business and earned a return of 19.3% and paid a finance cost of 5% to earn a net return of 14.3%. okay, but the payment of the loan could have a detrimental impact on the profitability. Okay, the payment of the loan could have a detrimental impact on the profitability. Okay, so this is how you can write the analysis part. Is it clear, everyone? Tell me. Is it clear, everyone? Tell me, guys. If the question is silent, you can take debt plus equity, or you can write debt by equity also. Whatever you are using, just write the formula there. Okay, if the question is silent for debt equity ratio, just write the formula there and solve it off. Just write the formula and solve it off. Okay, so this is all about the section C of the mock exams. I think that it would have helped you guys. Okay, now by tomorrow I will make a video on the common mistakes that a student does for the FR paper, okay, and post on the YouTube, okay, so that you can watch and do not repeat those mistakes in the exam. So on that note, thank you all of you, and wish you all the best for your exams. Wish you all the best for your exams. Okay, that's all from my side. Thank you guys. Now definitely from where you have to start paper, I will recommend start from section A, then section B, and then section C. Why? Because if you start with section C, it might take sufficient time, it might take significant amount of time, and then in that case what will happen, you will feel panic, and you might make mistakes in the exam for section A and section B. Okay, so if you take my recommendation, always start with section A and section B, because in section A and section B, either it is correct or it is wrong. Okay, either it is correct or it is wrong. But in section C, even if you are making a mistake, then in that case what happens, you do have a chances of using the own figure rule to secure marks. Okay, so you can afford to make a mistake in section C, but not in section A and section B. Okay, so always start with section A and section B, so that you can solve it with free mind, and then you can solve section C. Okay, how much mind, if you ask me, for see, though it depends from person to person, but ideal time which I will recommend you is 1.5 hours. 1.5 hours for section A and B, and then section C 1.5 hours. Okay, yes, definitely we'll meet in SBR paper, guys. Okay, that's all. Now yes, please do comment in the comment section. Okay, please comment, please give the feedback in the comment section, all of you. Thank you, bye bye.